Brad Williams, Frugal Finance, Securitization. Definition, pros and cons, and example. What is securitization? Securitization is a financial process that involves pooling various non-liquid assets such as loans or debt and transforming them into tradable securities. By doing so, investors can purchase shares in these pooled assets and receive a return based on the underlying loans, principal, and interest payments. This technique is commonly used for mortgage loans, auto loans, credit card debt, and other consumer or commercial debt. Key takeaways: securitization involves pooling assets to create marketable securities. These securities pay investors based on the interest and principal payment of the underlying debt. Types of securitized products include mortgage-backed securities and asset-backed securities, backed by assets like mortgages, auto loans, or credit card debt. The process enables lenders to offload loans from their balance sheets, improving liquidity and capital availability. How securitization works? In securitization, a company or financial institution known as the originator identifies and selects assets, often loans it no longer wants to manage or needs capital to fund new loans. These assets are grouped into a portfolio which is then sold to an issuer that creates tradable securities backed by these pools of assets. The issuer creates these securities by dividing the pooled assets into tranches, different layers of risk that cater to various investor appetites. Investors purchase these securities, receiving payment based on the principal and interest paid by the debtor of the underlying loans. The process allows the originator to remove these loans from its balance sheet and free up capital to issue new loans. Steps in the securitization process. Securitization involves several stages. Asset origination, a lender, like a bank, issues loans to a borrower. Asset pooling, loans are grouped into a portfolio based on shared characteristics like loan types and maturities. Creation of special purpose vehicles, an SPV is set up to hold the assets and protect them from the originator's financial issues. Asset transfer, the assets are sold to the SPV and the SPV issues securities to investors to fund the purchase. Tranching, the assets are divided into different risk levels, with senior tranches having lower risk and higher returns and junior tranches offering higher risk and potentially greater returns. Credit enhancement, methods like over-collateralization or third-party guarantees are used to increase the appeal of the securities. Rating, credit rating agencies assess the securities and assign ratings based on their perceived risk. Sell, the securities are marked and sold to investors who choose tranches based on their risk tolerance. Cash flow distribution, payments from the underlying loans are distributed to investors according to the terms of the securities. Types of securitization. Securitization can take various forms depending on the structure and the type of underlying assets. Pass-through securitization. In this basic form, cash flows from the underlying asset are transferred directly to investors. For example, mortgage-backed securities are often structured this way, where investors receive a proportional share of payments made by homeowners. Pay-through debt instruments, more complex than pass-throughs. This type involves debt obligations like collateralized mortgage obligations and real estate mortgage investment conduits, where cash flows are allocated across different tranches. Collateralized debt obligations. These securities pool various types of debt, such as corporate bonds, loans, or other securitized products, and divide them into tranches with different risk levels. Advantages and disadvantages of securitization. Advantages: increased liquidity. By turning illiquid loans into tradable securities, securitization allows investors to access assets they otherwise could not. Capital efficiencies. Originators can remove loans from their balance sheet, freeing up capital to issue more loans. Diversification. Investors can diversify their portfolio by purchasing securities backed by different types of loans. Income generation. Investors earn income through interest and principal payments made by borrowers. Disadvantages. Default risk. Investors face the risk of default on the underlying loans, affecting their returns. Complexity. Some securitized products like CDOs are highly complex, making them difficult for investors to fully understand. Lack of transparency. The underlying assets may not always be clear, leading to uncertainty about the risk involved. Prepayment risk. If borrowers pay off loans early, the expected cash flows to investors could be disrupted. Examples of securitization. A common example of securitization is mortgage-backed securities. For instance, agencies like Fannie Mae and Freddie Mac pull mortgages from homeowners and issue mortgage-backed securities to investors. The investors receive regular payments from homeowners' mortgage payments, which include both principal and interest. However, investors face risks such as prepayment, where homeowners may refinance or pay off their mortgage early, potentially altering the expected cash flows. Regulation of securitization. Securitization activities are regulated by financial authorities like the U.S. Securities and Exchange Commission and the Finance Industry Regulatory Authority, FINRA, which ensures that investors have access to accurate information about the securities they purchase. Conclusion: securitization is a powerful financial tool that allows for pooling of debt to create marketable securities. It benefits both originator and investor by providing liquidity and income opportunities. However, it carries risks such as default, lack of transparency, and prepayment, which must be carefully considered by all parties involved. These are complex investments that led to the 2007-2008 financial crisis. If you don't understand cash flow, if you don't know how to price a mortgage-backed security or a CDO, then stay away from these investments. They're too risky. But if you're sophisticated and understand the pricing and how to discount these particular investments to determine what's really under the hood, then they're great investments. As I said, they're pretty technical, and if you don't understand them, then either break open a book on securitization or just stay away from them. If you have any questions or concerns about securitization, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.